Hi friends, today let us take a closer look at a stock that has been on quite a rally recently. Since March this year, the share price has jumped from about 300 to nearly 600 just last month, effectively doubling. If we go back to May last year, this stock was trading at just around 124 rupees. And so we are talking about 4 to 5 fold increase in a relatively short period of time. If you take a look at this graph, you can see how the trading volume has really picked up over the last 2 years, especially peaking this August. In this video, we'll try to understand what's driving this stock, its business, future outlook, valuation, risks, and whether it might keep rising or see a correction soon. Stick around till the end because I'll be discussing some important details about their business that you will definitely want to hear. Sterling Tools as a business started about 4 decades ago. It's currently managed by founders' two sons, Atul Agrawal and Anil Agrawal. Sterling Tools is the second largest manufacturer of automotive fasteners in India, although I should mention that they are only 1/6 of the size of the market leader, Sundaram Fasteners. Sterling makes all kinds of bolts, axle bolts, engine bolts, special fasteners, standard bolts, wheel bolts, and other components like screws, nuts, washers, rivets, and studs, which are essential for every automobile. Their client list is impressive, including big names like Honda, Eicher Group, Escorts, Hero, Ashok Leyland, Maruti, Isuzu, Mahindra and Mahindra, Hyundai, Suzuki, Volvo, and Tata Motors. The company has over 700 employees and 4 manufacturing plants, 3 near Faridabad, Haryana, and 1 in Kolar near Bangalore, Karnataka. Besides fasteners, Sterling Tools has also expanded into the EV market. At present, their EV portfolio is made up of a single product, that is motor control units or the MCUs. They manufacture MCUs for electric vehicles like 2-wheelers, 3-wheelers, and light commercial vehicles. If you're wondering what is an MCU, it's basically the brain of an electric vehicle's power system. It takes input from the driver like pressing the accelerator or the brake pedal, and also from the sensors around the vehicle like temperature sensor, voltage sensor, to control how much power that goes into the motor, and also manages converting the battery's DC power into the AC power that the motor needs. It even helps send energy back to the battery, charging it when the vehicle slows down using regenerative braking. It also keeps the motor and the other parts like the inverter from overheating, ensuring that everything runs smoothly and safely. The MCU interfaces with voltage and current sensors to monitor battery health and status as well. Sterling Tools manages their EV business through a subsidiary called Sterling GTech E-Mobility Limited, or Sterling GTech for short. It was set up in 2020-21 in collaboration with a Chinese company called GTech, which specializes in MCUs. Sterling GTech is a wholly owned subsidiary of Sterling Tools. GTech remains a technology partner with no stake in the firm. Sterling GTech has a plant in Faridabad for manufacturing MCUs and 2 technology centers, one in Faridabad and another in Bangalore. The plant currently has a capacity of 300,000 units a year, and it's being upgraded to produce 600,000 or 6 lakh units annually. This upgrade is almost done, and they are already rolling out about 2,000 MCUs per day. Sterling GTech is now the largest manufacturer of MCUs for the EV industry in India. They hold around 40% of the market share for 2-wheeler MCUs and about 20% for the overall auto sector. They got a head start by starting production early in 2021, which gave them an early mover advantage. The main reason for the recent spike in their stock price is the strong growth in their EV business over the last 2 to 3 years. Before we go into the financials of this company, let us take a quick look at the opportunity size for this firm. The Indian EV 2-wheeler and 3-wheeler sales is poised for a significant growth in the next few years. The fiscal year 2024 saw sales of around 10 lakh units of EV 2-wheelers, while about 6.3 lakh EV 3-wheelers were sold during the same period. While EV 2-wheelers saw a growth of 29% year over year, the EV 3-wheelers growth was a remarkable 56% year over year. The current sales of EV 2-wheelers is 10 lakhs. Now imagine the situation when number of EV 2-wheelers sold would be 50 lakhs or 5 million instead of the 10 lakh or 1 million sold in fiscal year 2024. This is not a very outlandish goal, since in India every year about 17 million 2-wheelers are sold. These numbers include bikes as well as scooters. While about 11 million of these are bikes, about 6 million are scooters and mopeds. At present, only about 5.8% of the two-wheelers sold are EVs. If this number increases to 25% by say 2030, when majority of the people are expected to choose EV scooters over ICE ones, and if the EV bikes capture about 10 to 20% of the market, we can indeed expect about 3.5 million EV scooters and about 1.5 million bikes sold to be EVs. Upfront cost of EV scooters is already comparable to that of ICE ones, and with very low operating costs, the sale of 3.5 million scooters out of total 6 million scooters looks reasonable. Ola is launching cheap EV bikes in a big way by the end of this year. Others are expected to follow suit, and hence 10 to 14% of the bikes being sold to be EVs is definitely a possibility by 2030. As far as three-wheelers segment is concerned, I am a little bit surprised that so many EV three-wheelers are selling in India. A total of 6,34,969 EV three-wheelers were sold in India in the last fiscal, and EV penetration in the three-wheelers is now a staggering 52%. This is huge considering the fact that penetration in two-wheelers is just a tiny 5.4%. This is despite the fact that there are so many players selling EV two-wheelers now, including the traditionally large auto players like Hero MotoCorp, Bajaj Auto and TVS, not to mention the high-profile startups like Ola Electric and Ather Energy. Now let us see how Sterling GTEC as an EV components manufacturer can potentially benefit from the growth of EV share in the two-wheeler and the three-wheeler market. The market share of Sterling GTEC in MCUs for two-wheelers is nearly 40%, and for the overall auto sector it's around 18 to 20%. Given these figures and given the fact that more than 90% of the MCUs sold by them are for the two-wheelers, and the penetration of EV two-wheelers is at present just 5% in India, we can see a future where Sterling GTEC may be able to double, triple or even quadruple their revenue when the penetration of EV two-wheelers reaches about 25 to 30% from the present 5 to 6%. If this indeed happens, their stock price may move accordingly, giving 2x, 3x or even 4x returns over the next few years. This is a huge opportunity for this firm, although the picture is not as rosy as it seems, as I'll explain later in this video. So hold on till the very end. As far as EV three-wheelers are concerned, less than 7% of the MCUs being sold by Sterling are for EV three-wheelers and LCVs as well. Strangely, I haven't heard Sterling management talk about possible growth of their EV business in the three-wheeler market. This may be because the EV three-wheeler market has grown exponentially and it has well-established players who don't need their help. For whatever reasons, they keep talking about the opportunity in the EV LCVs, that is light commercial vehicles, and how they have partnerships in place in that sector with Switch Mobility or Ashok Leyland, Volvo, Eicher and the Tatas. However, as per their opinion, the traction in LCVs is missing due to various reasons. High upfront costs, lack of charging infrastructure, competition from the EV three-wheelers and most important of all, missing subsidies for the LCVs in the government schemes like PM E-Drive and the FAME subsidies. There were no announcements made in the PM E-Drive scheme regarding the subsidies for LCVs, while EV two-wheelers and EV three-wheelers have received substantial grants in the subsidies, reducing the upfront vehicle costs for their consumers. EV two-wheelers are being granted Rs 10,000 per vehicle, while EV three-wheelers will receive 25,000 per vehicle under the PM E-Drive scheme. Hence, in the near term, it looks to me that they are dependent on the EV two-wheelers for their revenue unless they gain new customers in the EV three-wheeler space. The research group Precedence says the global EV vehicle parts and components market is estimated at around 200 billion in 2023 and is projected to grow at a CAGR of 22.5% from 2024 to 2032. The industry is expected to hit around 1,242 billion by 2032. As per this research report, the Asia Pacific region will be the one which will lead the global electric vehicle parts and components market during the forecast period of 2024 to 2032. While these estimates are great in that global demand for EV parts and components exists, it is not easy for a firm like Sterling Tools to get into the exports market. They have not had much success with exports in their traditional fasteners business either. Currently, only about 3 to 4% of their revenue comes from the exports, and as admitted by the management, it is one of the weak points in their business. If it helps you to understand the situation, their nearest competitor Sundaram Fasteners has nearly 30 to 40% of their revenue coming from the exports. Also, due to heavy customization and validation involved, it's not easy to sell EV components like MCUs to firms outside India unless they go for local plants or partnerships. One other area of expansion for Sterling Tools would be to manufacture EV components other than the MCUs. They have been trying hard to do this, looking for technical collaborations on that front, and recently they signed an agreement with a South Korean firm called Yongin Electronics to explore manufacturing components essential for charging systems, electric motors, DC-DC converters and power electronics that power the EVs. Currently there are only very small players in India for these products and no big international player has set up their shop here, and hence Sterling will have a first mover advantage with these products. Yongin Electronics is apparently one of the major suppliers of auto components for Hyundai Kia in the South Korea. This partnership is still in early stages though. They are just talking to potential customers to understand their needs, studying market requirements, etc. and it's expected to take at least a year or two to finalize what components they need to be manufacturing here. Once this is done, they need to form a JV with this firm, do greenfield expansion, that is find land, building, set up factory and acquire materials and machinery required to manufacture these components. Hence, the revenue from these additional EV components are not expected to arrive earlier than fiscal year 2027. The management expects about 200 crores of additional revenue per year from this expansion by 2030 or later. Hence, it will be a while before Sterling Tools starts building anything other than the fasteners and the MCUs. The company earns about 8 to 10,000 rupees from MCUs they sell for two-wheelers, and for three-wheelers they make about 10 to 12,000 rupees. This is about 8 to 10% of the wallet share for each vehicle sold by their customer. So if the scooter is being sold for 1 lakh, Sterling receives about 10k for supplying the MCU for the vehicle. On the other hand, in their fasteners business, the wallet share is only about 0.5 to 2%. No wonder their focus is to grow EV components business at present while keeping their fasteners business running. One important thing to note here is that all of the OEMs who signed up for MCUs with Sterling GTech are their existing customers from their fasteners business. Hence, as a leader in the automotive fasteners manufacturing, Sterling GTech is able to leverage its parent company's long-standing relationship with the OEMs. It is the strong relationship they enjoy with the OEMs from their fasteners business which led them to set up a factory for MCUs without a single customer order in the books. 3 years later, the EV business is now bringing nearly as much revenue as their fasteners business. In the most recent quarter, they earned 161 crores from the fasteners while MCUs fetched nearly 121 crores. The point that I am trying to make here is Sterling Tools has a wide customer base of auto majors here in India from their 40-year-old fasteners business, and which the management expects to tap into for their EV components business. With this background, let us look at the financials of this firm. In fiscal year 2024, the company posted a revenue of 938 crores as compared to 775 crores of revenue recorded in the fiscal year 2023. This is a rise of 21%. The profit before tax witnessed a jump of 14% to 72 crores in fiscal year 2024 from 63 crores in fiscal year 2023. The growth is mostly coming from the EV segment from Sterling GTech subsidiary, since the standalone revenue and profit from their automotive fasteners business was flat to negative in fiscal year 2024. The fasteners business is quite diversified, with two-wheelers taking up about 17 to 18% share, three-wheelers, tractors and farm equipments about 15 to 16% share. The share of commercial vehicles is about 20%, passenger vehicles about 25%, aftermarket retail is 10 to 15% and exports form 5% of the revenue share. Hence, there is no dependence on a single automobile sector in the fasteners business. They supply fasteners to Honda and Hero MotoCorp on the two-wheeler side and Maruti for passenger vehicle, and a number of players like Mahindra and Mahindra, Escorts, Eicher Group, etc. on the three-wheelers. They have tied up with Hyundai too for fasteners, but that partnership will become operational only in a year or two from now. Between fiscal year 2022 to 24, their EV business grew over 8.5 times, with EBITDA margin improving from minus 11% to a positive 7%. In quarter 1 of fiscal year 2025, their EV business grew by 63% year over year. In fiscal year 2024, Sterling GTech was able to secure business from 20 new customers, with top 5 customers contributing about 90% of the overall MCU revenues. And probably the top customer, that is Ola Electric, contributed nearly 80% of the revenue. The revenue from EV components business grew from 174 crores in fiscal year 2023 to 324 crores in fiscal year 2024, an impressive growth of 86% year over year. This was probably fueled by growth of Ola Electric scooter business. As I said earlier, Sterling wallet share is about 8 to 10,000 rupees per vehicle, and every one of the scooters sold by Ola comes with the MCU supplied by Sterling GTech. The Sterling GTech revenue jumped from 174 crores in fiscal year 2023 to 324 crores in fiscal year 2024 can be seen in the context of Ola scooter sales increasing from 152,000 units in fiscal year 2023 to 329,000 units sold in fiscal year 2024. This clearly shows the correlation between the number of Ola scooters sold and the revenue earned by Sterling in their EV business. The share of EV business in the consolidated revenue of the firm increased from 23% in fiscal year 2023 to 35% in fiscal year 2024. In quarter 1 of fiscal year 2025, the revenue share of EV components business was 43%. In 3 to 5 years, they expect the EV business to have about 60 to 65% revenue share. The margins on the fasteners business is about 14%, while MCUs presently fetch about 6 to 7% margins. In 3 to 4 years' time, they are hoping that EBITDA margin will improve to 10 to 12% in the EV business as they scale their business and capacity utilization improves. According to the management, the fasteners business is expected to grow 7 to 8% per year. The fastener business can increase up to 750 to 800 crores of revenue from the existing 608 crores of revenue for the standalone business of fasteners. This will happen with full capacity utilization at the Kolar plant near Bangalore, which is being utilized at around 50% capacity now. The management guidance is that EV business revenue will grow at 25 to 30% annually in the next 3 years, depending on the components mix they have in place and the new components they bring to the market. For components other than the MCUs they manufacture presently, they are looking at all aspects of power electronics, chargers, DC AC converters and the EV motor. The new products for EV business, including the ones from their partnership with Korean firm Yongin Electronics, are expected to come only in fiscal year 2026 and beyond, and these new products of course will be targeting existing customers from their fasteners and MCU business. The company debt to equity ratio is just 0.26, and they have indicated that the capex required for their expansion is very minimal, about 50 to 60 crores. Considering their current revenue and profits, the investment required is quite low. The company claims that unlike the regular auto components business, the EV components production involves lower capex, but the ROC is quite high, about 30 to 40%. The EV business relies more on technology and engineering than heavy manufacturing infrastructure. Hence, financially, the company is doing well. Now that we have seen the financials and business plans of Sterling Tools and its subsidiary Sterling GTech, let us now look at the competition, risks and challenges they face in their EV business. If you do like my video so far, a like from you will likely make the algorithm to recommend this video to other viewers as well. Thanks for your help. The fasteners business itself is quite stable since they have been operating in it for 4 decades now, and since they cater to diverse auto sectors. However, it is important to keep in mind that the automobile sector is cyclical and hence there can be a few ups and downs in the short term. They did have such occasions before, especially when they were dependent on a single big customer in a particular auto segment, and when the auto major faced a downturn, the revenue would suffer and the firm would post less than expected growth in their fasteners business. This happened with Maruti when it was the primary customer in the passenger vehicle segment, and also with Honda since they are the biggest customer in the two-wheeler segment for fasteners business. Regarding the EV parts business, based on their dominant market share of 40% in the EV two-wheeler segment, it is easy for us to assume that they are well placed in their business compared to other EV component suppliers and manufacturers. However, it is important to keep in mind that currently nearly 80% of their revenue comes from a single customer, that is Ola Electric. If for some reason Ola decides to stop buying MCUs from Sterling GTech, the revenue will come crashing down. Sterling may have some safeguards like contracts in place, but management has said in some of the conference calls that this will be a major decision for Ola, but it can indeed happen. In one of the earnings calls, the Sterling executive acknowledged that there was a demo video from Ola some time back where they showcased the EV platform which did integrate MCU with EV motor, but so far they have not proceeded with this new platform. At present, 100% of all Ola scooters are powered by MCU supplied by Sterling GTech, but tomorrow Ola or any other OEMs for that matter can decide to manufacture the MCU in-house to save costs or to customize and optimize the performance of MCUs to their needs. Two of the biggest EV manufacturers in the world, Tesla and BYD, do manufacture MCUs in-house. But most of the other global EV players have preferred to source their MCUs from external parties. I have a strong feeling that Ola is moving towards integrating their own MCU into their vehicles. In the recent event on the Independence Day, Ola announced the launch of their next generation architecture named Gen 3 platform with much fanfare, and this architecture will be common across all of their EV bikes and scooters to be released starting next calendar year. They claim that this will help them save something like 22% of the manufacturing costs while improving the performance by 26%. They achieve this by integrating battery, motor and electronics including the MCU into a single unit, which not only enhances performance but also simplifies manufacturing processes and reduces weight. There will be a single processor for the entire vehicle. Hence, Gen 3 platform will utilize a single processor unlike the current Gen 2 platform, which has 4 processors including the one used inside MCU supplied by Sterling GTech. So let me repeat this since this is so important to understand. For its Gen 3 platform, Ola Electric is moving towards integrating multiple components including the MCU, BMS or battery management system and other electronics into a single high-performance multi-core processor. This shift will simplify the electronics architecture and reduce the need for separate MCUs. Essentially, instead of using external MCUs such as those provided by Sterling tools, Ola is integrating these functionalities directly into its motor and electronic systems as part of the platform upgrade. Again, this integration allows for improved efficiency, better performance and reduced wiring complexity. It suggests that Ola is focusing on more in-house control over key components like the MCU by embedding them directly into the overall system, which could mean they are gradually moving away from relying on external suppliers for the MCUs. Given this risk of their biggest customer moving out of their existing contract and resulting slump of revenue, I would stay away from investing in Sterling tools unless of course they clarify two things. One, that the Gen 3 platform of Ola will continue to feature MCU manufactured by Sterling GTech, and 2, move to the Gen 3 platform by Ola for their scooters and bikes will not result in they losing their EV business worth 300 odd crores by Ola Electric. Sterling likely made 300 crores in the last fiscal from Ola Electric. Do note that none of the other EV two-wheeler OEMs that they supply MCUs to, that is Ampere, Simple Energy, Torque, Oben Electric, etc., command any significant share in the EV two-wheeler market. Hence, to recover from any potential loss of business from Ola Electric will take a long time. Also, chances of other big players in EV two-wheeler space partnering with Sterling GTech looks remote. Major player in the EV two-wheeler space, TVS, with its offering TVS iQube, will perhaps never work with Sterling tools because they are seen as a competitor from their fasteners business. Sundaram Fasteners is part of the TVS group. Other players like Bajaj Auto and Ather Energy have been making EVs for a long time now. Their process is probably stable and they likely have strong partnerships already in place. Bajaj Chetak uses MCU from Bosch, the global market leader in MCUs. Ather Energy sources its MCUs from Bharat FIH, part of the Foxconn group. These component manufacturers are big players with deep expertise, and it is unlikely that Sterling GTech can compete with them on scale and price. Hence, if you are invested in Sterling Tools or planning to invest in Sterling Tools, be aware of this big risk in the EV business as it currently stands. Please do not take this as a stock recommendation and do your own research before investing or exiting. So friends, that's my 2 cents on Sterling Tools and its subsidiaries. Thanks for watching and have a great day.